Hey traders, it's Danielle. Welcome to the free video. So, as I'm sure you know, it is earnings season, and earnings season brings about a couple different opportunities. Some of them pre-earnings trades, some of them earnings trades themselves, and some of them post-earnings trades. Now, if you know me, you'll know one of my favorite post-earnings trades is called the 2x move. What that is when you get a stock that it surprises on earnings, okay? Surprises on earnings, it moves twice what the market expected, and then boom, you get a momentum move that continues on for a couple days. So, as you can imagine, for someone who loves a little bit of excitement in my life, I love looking for the 2x move. One of my favorite aspects of the 2x move is when the ticker has high short interest. With Tesla, for example, you had an earnings move that was a surprise, and then with the high short interest, you get boom. You get not only momentum higher from people buying the stock, but you also get momentum from all of the shorts that are covering at the same time. That causes this explosive movement higher. So, as you can imagine, I'm always on the lookout for a short squeeze. So, what am I looking at right now? Well, you never know if you're going to get a short squeeze on earnings until after the report. The entire point of this trade is that the report could potentially cause a short squeeze. So if AMD reports and the report is terrible and it trades lower, there's not going to be a short squeeze, okay? But if the world sets everything up perfectly, I may get my short squeeze. So what would it look like? Well, with AMD, you have an earnings report coming up right here. You also have a situation where you've rallied into earnings, showing that we have positive momentum, okay? You also have a previous high that is within $2 of the current price, okay? And guess what? Your expected move on earnings is $3. So even if this bullish stock gets a move to the upside, that's within the expected range, it has the potential to squeeze shorts and therefore get some explosive price movement. Now, I've traded this move on AMD a couple different quarters. It doesn't happen every time because, what would the fun in that be? But I've done it a couple quarters, for example, right here. That one was, oh man, that one was amazing. This one, obviously, no short squeeze because you got a gap down. That one was a nice short squeeze. So you get my point. It could happen, doesn't mean it's going to happen. So what am I looking for? I'm looking for an earnings beat. I'm looking for a gap up above the previous high, and I'm looking for continued momentum. What that looks like on a 15-minute chart is it looks like a 15-minute range breach. Looks like a 15-minute range breach on the 15-minute chart that gives you continuation and keeps going after the fact. If it gaps up and rolls over and dies, doesn't count. That's not momentum, okay? You're looking for a gap above the previous high that continues on. In that instance, what would I do? Well, I love to buy, Delta 50 calls. Usually in these instances, you can get away with buying out of the money options. I normally never buy out of the money options, but in this only instance, buying some Delta 30s, Delta 50s, you can get away with that. Delta 70s are going to be better because they're going to hold their value better. And then I also like to buy them at least in this week's series. The next week is a little bit better, but if you have a smaller account and you want to stick with Delta 50s and you want to stick with this week, that's fine. With something like AMD where your options are already pretty cheap, I would prefer to go with the Delta 70s, give yourself another week. Just give yourself more time, more intrinsic value, and that is how you get into the short squeeze. Now, people always want to know, well, how do I get out of it? Well, this is a momentum trade. So what you have to do is you have to watch the momentum. You bring yourself down to a 15, 30-minute chart. You can look for the break of the low of the high bar. If you use a 15-minute chart, it's usually going to trail it pretty close. So 30 minutes is going to give you more room. But what you're looking for is you just want to see the momentum slowing, okay? So if you get this trading higher, trading higher, trading higher, oh, you got some wicks on the top, you got a break of the low of the high bar, that's a place you could trail your stop off at, okay? Just depends how close you want to trail it. So that is my trade idea that I have for you. I also want to let you know that I am going to be having a purely educational webinar next Monday with my friend Sean Feeney from the NASDAQ. We are going to be focusing on how to hedge in this market. Now, I don't know if you know, but typically after earnings season, what we see is we see a dip in the market, and it's a great time to add some hedges on. So Sean and I are going to be teaming up on Monday, November 4th at 7 o'clock. You can go to simplertrading.com/hedge. And we're going to walk through how you use NASDAQ products, the NDX, the NQX, the QQQs, when to hedge, and also how. So this is totally free. There's no class, nothing like this. We're just going to be teaching how to hedge. Make sure you sign up. Come join us. We'll see you there.